Hey folks, today I want to talk about a merger arbitrage strategy and how to take advantage of a corporate acquisition. In early 2022, Microsoft announced they want to buy Activision Blizzard for $95 per share. Now, it did not go to 95 on that news because there are still regulatory hurdles and there's a chance the deal might not go through. So today the stock price is at $85 per share, and a lot of people, including Warren Buffett, are looking at arbitraging this deal. Now, the problem I have with using the stock itself to arbitrage is that you always have that downside risk depending on if the deal goes through or not. For example, if you think ATVI will get acquired at $95 per share, then you would simply buy the stock today at $85, and when the deal closes, it goes to 95 and you make that $10 per share profit. The downside is if the deal falls through, the stock is probably going to tank and you could lose a lot of money. And if you're not so keen on the deal, then you can short the stock today at 85, and that way, when the stock drops, you can make a profit. The downside of short selling is, of course, if they do get acquired by Microsoft at $95 per share, the stock price will go up and you're going to lose $10 per share. So instead of using the stock itself, I'm going to use options. And I think in this particular case, using options is going to give a better risk to reward trade than just the stock. So in today's video, I'm going to show an option strategy for taking advantage of this potential acquisition. And this strategy is going to be profitable if the deal goes through and the stock goes to $95. And this might be surprising, but the same strategy will also be profitable if the deal doesn't go through and the stock tanks. And you might be thinking, well, this sounds too good to be true because you make money if the stock goes up to 95, but you also make money if the stock falls. Technically, it can fall to zero and you would still make money with this strategy. So the catch is the stock cannot rise too much over $95 before the expiration date of these options, because the higher the stock moves above $95, the more money this option strategy is going to lose. Now, realistically, the only way I can see the stock going above 95 is if another suitor comes in and tries to outbid Microsoft's original $95 offer, maybe like a Sony or some other company. But I think the chances of that are so small that this trade is still worth putting in. So let's get into it, and I'm going to explain the mechanics of this option strategy now and go into the details. Now, depending on who you talk to, I've seen anything from less than a 50-50 chance that the deal will go through to an 80% probability of a successful acquisition. So based on what we know right now, I think it's more likely than not the deal will go through, which won't be finalized until July 18th, but possibly later because the FTC wants to push this to at least August. So there's a lot of strategies you can use for this. The one I'm going to use is sort of a twist on ratio spreads. And I've talked about ratio spreads in the past and how they work. In this case, I'm going to make a bearish ratio spread. What I'm going to do is sell out of the money call options so that I am bearish on the stock. I think it will go down. But at the same time, I'm going to buy a closer to in the money call option. This is a net credit strategy, which means I'm going to be collecting option premiums. And if the stock goes down, so by the end of the expiration date, let's say it's going to be in July, if it goes down, I would make money. If it's flat, I would make money. And if it goes up a little bit, I would make money, as long as it doesn't go up too high. So let's go over how that works. I'm going to bring up the options chain over here for Activision Blizzard. So here you can see all the call options. You can use either May, June, or July. I'm going to go with July because there's not enough volume to do a ratio spread. You can see the ask quantity here is only 1, and you need at least 2, because the whole point of ratio spreads is that you buy one option and then you sell 2 options. And in June, there's not enough bids here. There's only 1, but for July, you can see there is enough here for a spread. So what I'm going to do is buy the $90 call, but at the same time, I'm going to sell the 92.5 call option. So I'm going to be paying over $3 for this, but I'm going to be receiving over $1.82 for selling this call option here. And what I want to do is just increase the number of units to 2. Now, right now, I just have a normal call ratio spread. If I take a look at what I can make here, I can make about $98. And you can see it says credit here, which means I'm going to be earning this in net credit. If I take a look at the profile, this is what it looks like. One issue with this ratio spread is that this long line over here on the left is below 0, which means there's a chance I'm not going to make any money if the stock goes below a certain price. Looks like it's around $90. So what I want to do with this is also sell a 95 call option. So altogether, I have 4 contracts. I'm buying the 385 call option, which is basically protection, just in case the stock does go up. And then I'm selling the 92.5 twice and the 95 call once. Because I've added the 95 call, this is going to give me an additional credit. And if I take a look at the profile now, you can see the shape is slightly adjusted, but now this line on the left here is in positive territory. That's $79. So if the stock ends on expiration date, July 21st, anywhere below looks like about $90, then I'm still going to be making about $80 from this trade. So if the Microsoft Activision Blizzard deal falls through and the stock drops from its current price of $85, then this strategy is profitable no matter how low the stock price drops to. Now, what if the deal does go through, like what a lot of people are anticipating? We can see I actually make the most money if the stock price goes to $92. The max return I can get is $330, which is quite a big profit. And that profit starts to diminish as the stock price moves higher than 92.5 until it gets to right over here. My break even is 95.4. That's going to be right here. If the stock finishes at 95.4, then I don't lose any money with this trade, but I also don't make any money either. Now, after 95.4, if the stock goes higher than that, then that's when I start to lose money. In fact, you can see if the stock price goes to $100 by the time this expires, then I can lose over $800. And that's because I have essentially 2 short calls that are uncovered. But the thing is, what are the chances of the stock going above $95, right? Because as long as the stock ends below 95.4, then this trade is profitable. And right now, by any measure, when you look at Activision Blizzard just on a fundamental basis, the stock is overpriced. Its PE ratio is 43, which is higher than it has been historically. Price to free cash flow also is now at a pretty high point and is at a premium compared to its 5-year average. If it wasn't for the Microsoft deal, this stock would not be as high as it is today. Maybe a direct competitor is Electronic Arts. You can see the price to cash flow per share is about the 5-year average, a little bit lower. So that's the kind of thing you would expect to see when earnings are expected to fall across the economy. So assuming Microsoft doesn't up their offer and there's not another company that's going to come in and bid higher for this stock, then the highest theoretical value that ATVI could get to is $95 per share. So if that is the case, like if we believe the highest price target on July 21st, where this blue line is 95, then this is almost guaranteed to be profitable according to this options chart. So in theory, the amount of credit I can get is 213, but because the spreads for these prices are so wide, I'm not sure if I can get that much. I'm going to try maybe negative 250 first and submit my order. And right away, that price has now dropped to 165 is the mid-range. So I'm going to go with negative 170 and update. And I'll just slowly, okay, let's go to 125.
Order filled.
Okay, so it filled at about $1. Price is $102, pay $2 in commission, so that's almost exactly $100. So here's my ratio spread, which is kind of like a butterfly call. I purchased one 90 call, I sold 2 92.5 calls, and then I sold another 95 call. Now here's what that looks like in my portfolio, and this whole thing required me to put up about $5,000 of capital, so I'm just using margin here, which doesn't actually cost me anything right now, but if you're using margin or if you're doing this with cash, just realize that this kind of strategy requires you to have about $5,000 on hand. And this profit and loss profile is only an estimation, so now that I've put the trade in, my actual break even is a little bit higher than this. It's actually 95.5. So if the stock finishes below 95.5 on expiration, then I would make money. If it finishes over this price, then I would lose money because I have one long $90 call. So I can buy the stock for $90 if I wish. Obviously, the higher the stock price goes, the better. So assuming the stock ends at 95.5 and I'm holding a $90 call, what this means is I can buy the shares at 90, sell it at 95.5, and I can make a $550 profit. However, I also have 2 short calls at 92.5. And because I'm short the call, I don't want the stock price to go up above 92.5. So if it finishes at 95.50 and I have a short call at 92.50 minus 92.50, that means I'm going to be losing $3 each on these calls. And because I have 2 of them, that is going to be minus $6 for me. And then finally, I have one more short call at $95 that I sold for a credit, and I'll be losing 50 cents on this. So in total, if we add all this up, it's a negative $1 per share, or times 100 shares per contract, that's minus $100. But because I earned $100 in net credit from putting on the strategy, the loss from the expiring options basically offsets the credit that I earned today. So that's why 95.5 is break even. So looking at the stock chart, if the stock finishes like up here somewhere, I would lose a lot of money. But once it drops down to 95.5, then this is when my trade will break even. Since the highest I expect the stock price to go is 95, it means I'm expecting to make at least $50 from this trade. Now, if the deal doesn't go through, or if the date is extended and the stock ends at like 94 or 93, then that's where that hump comes in the profit, and I can make like $200 or $300. And then it tapers off until it gets to about $90, in which case I'll make $100 in profit just from the net credit, because all of the options will expire out of the money. So they're all going to be worthless, and I just keep whatever premiums I earned. So July 21st, the expiration date, in 106 days, I will give an update. And either the deal goes through, it goes to $95, or the deal doesn't go through and I make money, or if they delay the acquisition, but the stock moves up anyway to $92 or $93 because it's likely to go through, then I can make an even bigger profit. There's also the choice to close this strategy early, right? I can just right click and then close. In any case, this is just how I'm playing this acquisition arbitrage. So thanks a lot for watching. I'll keep you guys posted. Good luck with your investments, and until next time.